The roaring 2023 bull market is creating more money-making potential than we've seen in over a decade. But how can you seize this once-in-a-lifetime opportunity to secure life-changing wealth? Most investing wisdom suggests waiting for the perfect conditions in the market. However, the reality is that when a seemingly surefire chance appears, it's often too late to take advantage of it. Billionaires understand that markets can be unpredictable, and things rarely line up perfectly. So, when an opportunity shows up, they grab it and take calculated risks before it slips away. This bold strategy works because good luck tends to favor those who take action. If you want to buy real estate, invest in cryptocurrencies, or get into something when it's cheapest, you have to make your move before everyone else catches on and drives the prices up. Typical advice from financial experts tells you to put together a balanced mix of stocks, bonds, real estate, and more in your investment portfolio. But billionaires don't always stick to this one-size-fits-all approach. Instead, they go with what's smart at the moment, focusing on things that might be undervalued or technologies that are about to change the game. They don't just stick to a fixed plan. They adjust and move their money around as needed, knowing that market ups and downs are just part of the deal. Their willingness to take on more risk for a potentially bigger reward shows how practical and flexible they are in their approach. It's not always about following the rules. It's about making the smartest moves in a changing world. Though there has been a recent period of decline, stock prices have displayed significant upward momentum throughout this year. The S&P 500's performance in the first half has been notably robust, marking its most impressive showing in 4 years. In parallel, the Nasdaq has outperformed even further, attaining a level of achievement that stands as the most remarkable in the past 4 decades. This current landscape hints at the potential for further growth, with major indexes formally transitioning from bear markets to a fresh phase of bullish market activity. The small-cap index, Russell 2000, was the trailblazer in breaking free from the bear market scenario, accomplishing this feat in August of the preceding year. Following suit, the Dow Jones Industrial Average emerged from its bear market status in November of the same year. In a similar vein, the mid-cap S&P 400 index exited its bear market phase in late January of the ongoing year. A mere 2 months ago, in May, the Nasdaq signaled its transition to a bullish market phase by putting an end to its bear market status. Lastly, the S&P 500, one of the major indices, joined this positive trend just last month in early June. A noteworthy indicator that predicted this upcoming upswing was the performance of the small-cap and mid-cap indexes. While these indexes were among the initial contenders to escape the clutches of the bear market, they struggled to keep pace with their counterparts for a significant duration of this year. Admittedly, the remarkable double-digit gains observed in the S&P 500 and Nasdaq were predominantly propelled by the top 10 stocks nestled within their respective indexes. Eminent names such as Apple, Microsoft, and Nvidia made noteworthy contributions to these gains. Things changed in early June when the small-cap and mid-cap indexes started doing better. This showed that the market rally was getting bigger and more widespread, which was a good sign for things going up. Another sign that this was happening came from the equal-weighted S&P 500 index. This index is a bit different from the one most people pay attention to, which is the market-weighted S&P 500. Surprisingly, the equal-weighted S&P 500 was actually going down for the year until it turned around in June. This all meant that the rally in the market wasn't just about a few big players anymore. More kinds of companies were doing well, and this was a key moment that signaled the start of an upward trend. Traders didn't waste time getting back into the stock market. They knew that things were looking up, and they wanted to be a part of it. Looking at the performance of different indexes so far this year, we can see this trend in action. The Dow went up 1.77%. The S&P 500 went up a lot by 14.6%. The equal-weighted S&P 500 index, shown by an ETF, gained 5.15%. The small-cap Russell 2000 index went up 5.87%. The mid-cap S&P 400 index went up 7.11%. And the Nasdaq index shot up an impressive 30.5%. While technology companies were still a big part of this growth, as seen by the big jump in the Nasdaq, the other indexes were also making strong moves to catch up. People are expecting these gains to keep going for the rest of the year. There are some good reasons for this, making 2023 look like a year where the stock market is really booming. If you want to make the most out of 2023's bull market, you start by educating yourself. Educating yourself about investing, financial markets, and different investment strategies is crucial for making informed decisions and maximizing your wealth-building potential. One way to educate yourself is by reading books and articles written by renowned investors and financial experts. For instance, books like The Intelligent Investor by Benjamin Graham or A Random Walk Down Wall Street by Burton Malkiel provide valuable insights into investment principles and strategies. These resources can help you understand concepts like value investing, diversification, and risk management. Attending investment seminars, workshops, or webinars is another practical way to enhance your knowledge. Diversifying your portfolio across various asset classes reduces risk and enhances your profit potential. For instance, invest in stocks from different sectors like technology and healthcare. Allocate a portion to stable bonds such as government and corporate bonds. Real estate diversification can involve residential, commercial, and industrial properties, along with real estate investment trusts. Commodities like gold and oil act as inflation hedges. Diversification doesn't guarantee profits, but helps mitigate market volatility. Assess risk tolerance, seek professional advice, and regularly review and rebalance your portfolio. Another risk management option is dollar cost averaging. The key principle behind dollar cost averaging is that by investing a fixed amount consistently, you buy more shares when prices are low and fewer shares when prices are high. This strategy helps to mitigate the impact of market volatility and removes the need to time the market, which can be challenging even for experienced investors. For example, let's say you decide to invest $500 every month in a particular stock or fund. If the price per share is high, your $500 will buy fewer shares. Conversely, if the price per share is low, your $500 will buy more shares. Over time, this approach can result in a lower average cost per share. Dollar cost averaging is particularly beneficial during volatile market conditions. When markets are experiencing fluctuations, investors may feel uncertain about the best time to invest. Investing in growth stocks can be a practical strategy to potentially increase your wealth. Growth stocks are shares of companies that are expected to grow at an above-average rate compared to the overall market. One example of a growth stock is Amazon. Over the years, Amazon has consistently demonstrated strong revenue growth and expanded into various sectors, such as e-commerce, cloud computing, and streaming services. It's important to note that investing in growth stocks involves risks. The stock prices of growth companies can be volatile, and not all growth stocks will perform as expected. Conduct thorough research, assess your risk tolerance, and consider consulting with a financial advisor before making investment decisions. As we discussed earlier, index funds are mutual funds or exchange-traded funds, ETFs, that aim to replicate the performance of a specific market index, such as the S&P 500. One of the most well-known index funds is the Vanguard 500 Index Fund, which tracks the performance of the S&P 500. By investing in this fund, you gain exposure to the 500 largest publicly traded companies in the United States. This diversification across various sectors and industries can help mitigate the risk associated with investing in individual stocks. One practical advantage of index funds is their low-cost structure. Since index funds aim to replicate the performance of a specific index rather than actively manage a portfolio, they have lower expense ratios compared to actively managed funds. This means more of your investment returns stay in your pocket rather than being consumed by fees. So there you have it. Thanks a bunch for watching. Be sure to leave a comment, and before you leave, why not like and subscribe? See you next time.